Global room night growth plummeted from a healthy 8% run rate, down to a near flatline 1% in the month of March alone. The catalyst was geopolitical, but the casualty was the balance sheet, with millions in sunk marketing costs incinerated on bookings that will never materialize into revenue. This is the reality of the tape. At FinWitness.com, we decode company dynamics and financials with verified metrics. Today, we are ripping into the first quarter of 2026, Form 10Q, for Booking Holdings. For those outside the trade, Booking Holdings is the apex predator of the online travel agency space, controlling the digital tollbooth between global travelers and their hotel or short-term rental beds. The stakes here are binary. Either they maintain their frictionless extraction of fees from global wanderlust, or macro turbulence grounds their growth engine. What we uncovered in this filing is a classic tug-of-war. Excellent corporate execution is colliding head-on with deteriorating macroeconomic conditions. Wall Street analysts love to model straight lines and eternal travel booms, but the actual filings tell a different story. The Middle East conflict did not just isolate regional travel. We pulled the transcript. Management explicitly warned that the conflict is directly impacting vital Europe to Asia travel corridors. This acute March deceleration triggered massive sunk cost marketing destruction. Because performance marketing, specifically paid search, is expensed the moment a booking is made, the late first quarter spike in cancellations completely crushed their marketing return on investment. The company effectively handed cash to Google for revenue they will never see. There is another chilling admission buried in the risk factors. Management stated they expect search engine optimization traffic to decline in the short to medium term. This forces Booking to rely even more heavily on paid marketing channels, compressing margins unless direct app adoption can outpace the search engine decay. They are aggressively trying to counter this by migrating users to their mobile app, and they are seeing success. Mobile app bookings just crossed into the high 50s% range. That is a massive defensive moat, permanently lowering customer acquisition costs for that specific cohort. But as forensic auditors, we read the fine print. The filing explicitly notes that accommodation reservations made on a mobile app are typically for shorter lengths of stay, and carry lower average daily rates. This means that as they successfully push users to the app, they are mathematically dragging down their average order value. Volume must increase substantially just to offset the lower transaction value. On top of this, they are facing regulatory strangulation. The European Union's designation of Booking as a gatekeeper and a very large online platform is guaranteed to bloat compliance operating expenses. Simultaneously, the newly enacted BBB Act and European digital services taxes, which extract anywhere from 1.5 to 10% of revenue, are direct, unavoidable hits to free cash flow and their effective tax rate. That is exactly why you need FinWitness.com. We strip away the PR jargon to show you the verified metrics. Now, closing that file and shifting our radar to the broader margin profile, and what it means for the stock. Despite the top-line bleed in March, Booking Holdings has fortified its financial bunker. The transformation program they initiated in 2024 is paying off rapidly. Management already realized $250 million in savings in 2025, and is locked in to achieve a $550 million annual run rate by the end of 2026. Crucially, the costs to achieve this are capped at less than 1 times the run rate savings, providing a clean margin tailwind moving forward. If you are questioning their liquidity, look at the working capital float. Deferred merchant bookings currently stand at an astronomical $8.2 billion. This represents cash received from travelers before the trip even occurs. In a high-interest rate environment, holding $8.2 billion in traveler cash before paying the hotel partners is a massive, hidden yield generation engine. They are heavily armed to defend their share price. The company is sitting on an $18.2 billion remaining share repurchase authorization. That is a buyback bazooka waiting to be fired at any sign of significant algorithmic weakness. Combine that with a pristine debt profile, where only $650 million is due in the next 12 months out of a $5.4 billion total, and their liquidity is bulletproof. They also just declared a 42-cent per share dividend payable on June 30, 2026, signaling absolute confidence in their cash generation. But you cannot ignore the structural margin dilution. 3 of their core growth pillars, which include non-accommodation services, the shift to a merchant model, and alternative accommodations, all carry structurally lower margins than their legacy agency hotel business. Speaking of alternative accommodations, their property count surged to 4 million, making up 38% of total room nights. They are aggressively taking market share in an arena dominated by Airbnb. But there is a geographic trap here. The filing notes that alternative accommodations are disproportionately located in Europe. Remember the Europe to Asia travel corridor slowdown we discussed earlier? Their fastest growing, highly touted segment is sitting directly in the blast radius of the geopolitical slowdown. If Europe softens, this segment will decelerate violently. Here is the final forensic verdict based entirely on the unredacted data. Over the short term, looking at the next 1 to 30 days, the outlook is strictly bearish. The sudden deceleration to 1% growth in March, combined with busted first quarter marketing returns, sets up a dangerous second quarter. Because a notable portion of their marketing spend occurred prior to the onset of the conflict, expect management to severely tighten the reins on performance marketing to protect margins. This refusal to pay up for uncertain traffic will likely create a self-fulfilling prophecy of slower top-line growth, triggering near-term algorithmic and fundamental selling. However, zooming out 6 to 12 months, the long-term outlook is highly bullish. The underlying business is fortifying its moat. Excluding the Middle East conflict, first-quarter room nights would have grown 8% year-over-year, and global average daily rates increased by 1% on a constant currency basis. The core consumer remains healthy. Once the macro turbulence clears, the $550 million run rate savings kicking in by year-end, the $18 billion buyback arsenal, and the permanent shift toward direct app traffic make this a highly compelling asset. We are analyzing the latest earnings and SEC filings in real time every day, ensuring you are staying one step ahead of the market. To access the unredacted radar, visit finwitness.com, upgrade to Pro today.